Good morning, everyone.
Happy morning, sir.
Good
Good
morning.
morning, sir.
Good morning. So, we are here for the final discussion on consolidation, a quick conceptual revisit of everything that is critical in your consolidation chapter in your SBR paper. Now, consolidation, is tested for a good. So, although the 30 mark question they say is on consolidation, not the entire 30 marks could necessarily be on that. Maybe a small portion of that could be from revenue, or it could be from another accounting standard as well. So there will have to be a balance. Maybe some of the calculations that you did in the, say, revenue adjustment, or some of the calculations that you did in the pension subpart will have an impact on how the consolidation activity process progresses. Okay, so of course, when we did our regular class, we understood a lot on in terms of how the consolidated balance sheets are built, and we took it up right from the knowledge level discussions. Right now, what I am going to do is I'm going to touch upon only those aspects which are tested in your SBR paper. Not like end to end nahi hoga, it will only be focused on the requirements in the SBR paper, which is why one of the first points that we need to revise is, how do you define control, or what exactly is control? An investor has an investor controls an investee when the investor has power over the investee, and the investor is exposed to or has rights to variable returns from its involvement with the investee, and the investor has the ability to affect those returns through its power over the investee. The fact that they have mentioned variable returns is indicative of the fact that you cannot acquire control through debt. You can acquire control only when you hold equity. Okay, then investor has the ability to affect those returns. What does that mean? This means that because the investor has the ability to tell the other entity what to do and what not to do. It is possible for the investor to guide the business activities of the other entity, thereby having the ability to control those returns. And of course, power over the investee is the ability to make decisions with regards to the business operations. Now, while the easiest way to establish control is by having a more than 50% voting share, there are other ways also in which control can get established. What are these? Contractual arrangement between the investor and the investee, or investor and other parties. Uh, I hold 40% shares, but I have an arrangement through which I am in the position to appoint a majority of directors on the board. Although my holding is less than 40%, that could potentially give me control. Holding less than 50% of voting rights with all other equity interests held by a numerically large, dispersed, and unconnected group. Company A holds around 46% of the equity interest of Company B. Now, it's not usual to get control with less than 50% holding, but the fact remains that in case of so if I hold 46% shares, but the remaining shares are held by numerically large, it has to be a large number of dispersed and unconnected shareholders. When I say dispersed, what I mean is they should not be together, they should be scattered all over the geographical expanse of the country, and it has to be an unconnected group of shareholders. Why is the word unconnected so important? See, if these people were connected with each other together, these remaining shareholders who own 54% of the shares could come together to exercise control. Okay, they could have a contractual arrangement between them which could help them establish control. So that cannot be the case. So when we are talking about exercising control, it has to be all other equity interests held by a numerically large, dispersed, and unconnected group. Okay, then those holding potential voting rights that are currently capable of being established. Convertible loans which have not been exercised so far, but there is a high probability that these particular convertible bonds or convertible debentures will get exercised in the future. It is not necessary that the option has to be in the money. It can be slightly out of the money also, but as long as over the long run, the business entity is able to get that debenture holding or that shareholding converted into equity, and it has a willingness to do so, and it makes financial sense to do so, then those potential voting rights could also lead to a situation of control, or the nature of investors' relationship with other parties that may enable that investor to exercise control over an investee. So, nature of investors' relationship in this case means maybe I am A Limited and then there is a B Limited. Now I own only 40% shares of C Limited, but I own 100% shares of B, and through B and through myself, I exercise a control over the other company. So all of these are different indicators of holding company establishing a control over the subsidiary. Okay, I just want you to have a close look at situation 3. Then we'll take it further. Tell me once you're done with 3, because then I would want you to read situation 4. Okay, I'll take you to situation 4 now. Okay, I'll scroll a little further. Look at the two convertible debentures case 1 and case 2, and how the two are different. Please try to understand. Done?
Yes, sir.
Complete the, I mean, entire analysis. Okay, and of course, the last one is that the entity has a contractual arrangement with another entity, the nature of investors' relationship with other parties that may enable that investor to exercise control. Now, there are only two situations in which you get an exemption from the activity of consolidation. Can you tell me what those two situations are? Garvit,
So intermediary parent.
intermediary parent and investment entity, right?
Invest.
Okay. Now, how would we define an intermediary parent, or what kind of a situation is primarily exempt here? Let's try to understand. Now, an intermediate parent, so where does this situation apply? So look at this. X company holds 90% of Y and Y holds 70% of Z. We are talking about this type of a situation. Y is your intermediate parent. X is the ultimate parent. Y is the subsidiary of X. And Z is the subsidiary of Y. IFRS 10 permits a parent entity not to present group financial statements, provided all of the following conditions apply. It is a wholly owned or partially owned subsidiary where owners of the non-controlling interest do not object to non-preparation. So Y Limited, in Y Limited, X Limited holds 90%. That means remaining 10% is held by non-controlling interest. And these non-controlling shareholders, they do not object to the fact that Y company will not prepare its set of consolidated financial statements. The company's debt or equity instruments are not currently traded in a domestic or foreign market. Neither are the securities in the process of getting traded or in the process of getting listed. And the ultimate parent, that is X Limited, it produces consolidated financial statements as per IFRS standards. In that case, if all these conditions are fulfilled, Y Limited will be exempt from preparing the consolidated financial statements. And then, of course, you have investment entities, an entity that obtains funds from investors and provides them with investment management services. Like, think of a mutual fund, like SBI Mutual Fund holds 70% of the shares in SBI, but then you will not treat it like a subsidiary, because in these situations, the intention is not to establish control, but wealth management and other aspects. So the holding company will not necessarily participate in the day-to-day activities or in the decision making. Any reasons apart from these are considered as invalid reasons for not consolidating. So if in an ethics question, they say that, the finance director has felt that this is a small subsidiary or this is a loss-making subsidiary, so we have decided not to consolidate that, then naturally that situation, you have to point out that this is incorrect, because IFRS does not permit you, apart from these two reasons, no other reason is considered as a valid reason. Okay, now your analysis of whether a particular of what you have acquired, is it a business or not? For this, you might have to apply two separate tests in a question. Okay, one is the optional concentration test and the second is the elements of a business test. What does the optional concentration test tell you? The concentration test is met, that is, the acquired assets are not a business if substantially all of the fair value of the total assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. Now think of a situation where I want to acquire Garvit's business. But when I want to acquire Garvit's business, I make a proposal and he gives me four assets. Okay. He gives me tables, chairs, then machinery and building. Now the standalone value of these four items together is around 100, and then I am also paying him around the same amount only. The idea behind the concentration test is that the entire value of the business should not be concentrated in just a couple of assets, because assets don't make a business. Assets are an ingredient of the business. What makes a business? Maybe certain technical know-how, certain processes, the good reputation, the good name of the business, the goodwill of the business. These are the external factors, or these are, rather some of the intrinsic factors, I would say, that give a business its identity as a business. See, a table, chair, and a building, they don't make you a business. What makes you a business is whether you have these other intrinsic aspects which basically add value to the situation. So, the optional concentration test, if the entire value of the business is concentrated in just a couple of assets or a group of similar identifiable assets, then in that case, it would not be considered a business. Okay, then apart from that, we have the elements of business test. There are three elements of a business: input, process, and output. Now, are all three critical? Output is not necessarily critical, but inputs and processes are. So they you could have a freshly brewed startup, startup entity, which is, it is still in the research and development phase. The final product is not out there. In that situation, outputs are not required, because an output is not necessary to constitute a business. On the date of acquisition, what you have to see is, do you have, or are you in the process of, or are you in the zone of arriving at your output quickly? You need not have like a final product ready to be sold or final product already selling on the date of acquisition. It is okay if you don't have an output. If there are no outputs at the acquisition date, then an acquired process is substantive only if it is critical to convert an input to output, and inputs acquired include a knowledgeable, skilled, organized workforce able to perform that process on other acquired inputs or to produce outputs. See, inputs are of course there, but again, the emphasis, if you observe, is on processes. Does the process have the ability to transform inputs into outputs? Is it something which is critical to convert? I mean, if somebody is doing housekeeping and maintenance work, great, but it is not a revolutionary process which will require any specialized skill set. That is not the situation. So, the process that we are talking about is the kind of process which is super critical to convert the input to an output, and the inputs acquired include a knowledgeable, skilled, organized workforce able to perform that process on other acquired inputs. So the process should be in a sense, it's not necessary that it has to be performed on the same set of inputs. Even if performed on any other set of inputs of a similar nature, it should be able to give you the same kind of output. And if there are no outputs at the acquisition date, then an acquired process is substantive if it is critical to continuing to produce outputs and inputs acquired outputs, and the inputs acquired include an organized workforce with the skills and knowledge to perform the process, or significantly contributes to the ability of an entity to continue producing goods and is rare or not capable of easy replacement. Again, going back to the housekeeping example, the housekeeping process is not a rare process. I mean, it doesn't require a lot of technical know-how, but yes, a research process could be a critical process, and without that, the conversion of input into output by any other individual is not possible. Which is why it is important that you understand the significance of why the process is important, and no inputs at acquisition date, there is an and condition. If there are outputs at the acquisition date, there is an or condition. So be careful while applying that in the exam. Not that they will ask you questions at the same level of detail. Okay. To understand the previous situation better, the two tests better, I want you to read through this question once. Tell me when you want me to scroll. Huh? Okay. Tell me when you want me to scroll, huh?
Sir, please scroll down.
ठीक है. Not that it has been asked on too many occasions, but it has been tested a couple of times, so best to be prepared for this topic as well. Okay, let's move on to the next one, which is basically a quick analysis of concepts of associate and joint venture. Now, associate and joint venture will often form a critical adjustment in your questions. And what is an associate? An associate is an entity over which the investor exercises significant influence. When we use the word significant influence, it is the ability to influence the activities of the entity but not control. Significant influence is established through holding more than 20 but less than 50% shares. Okay, now you could also get the same significant influence by the ability to appoint a significant number of directors on the board but not well enough to establish control, which means if you have a 5 director board and your company has the ability to appoint 2 directors, then that means again you have significant influence. So IS 28 specifically says that significant influence can be achieved by the ability to appoint members who will have significant influence on decisions or holding between 20 and 50% of the voting power. Such an entity is an associate. You don't use the acquisition method or the line by line consolidation method. We use the equity method of accounting. Now, how does the investment in the associate entity appear in the balance sheet? Cost of investment in the associate plus share of the investor in post acquisition profit, less impairment loss, less group share in unrealized profit. Remember that this impairment loss is not impairment of goodwill, because in case of associates you don't calculate the goodwill separately. This is impairment of the investment. And whatever adjustments you do on the asset side in the cost of investment, the same adjustment is done in the balance sheet on the liability side in the consolidated retained earnings. Okay, consolidated retained earnings mein you will have to add share of post acquisition profit, less impairment loss, less group share in unrealized profit. Same set of adjustments that you did on the asset side in the cost of investment, you have to do in consolidated retained earnings. And the impairment loss is calculated every year on the reporting date. Now, the same exemptions which applied for consolidating a subsidiary apply for consolidation of an associate, the intermediate parent one and the investment entity one. A long-term loan to an associate or a joint venture. A long-term loan to an associate or a JV is also included in carrying amount of investment and is not presented as a separate financial asset in the balance sheet. Basically, if I have made a 35% investment in in another entity which gives me significant influence, and then I have given a loan to that entity. In that case, the amount of loan will get added to the amount of equity investment. You don't do the two investments separately. There is no separate goodwill calculation. It is assumed to be included in the carrying amount, and other changes in fair value of the investment, they are recognized in your P&L. Okay, now how does the consolidated P&L get affected by the associate? Calculate the post-acquisition profit of the associate, calculate the investor's share in that, and include that share in the consolidated P&L. See, dividend is distributed profit. So if the associate company has given you a dividend, you have please be aware of the fact that the share of profit has already been included, which means that is the bigger number. Now that same associate has given you a dividend. There is no point in including the dividend if you have already included the amount of investment in the associate. If you have already included the share of profit, then no need to include the amount of dividend again. That will lead to double counting. Same thing goes for OCI of the associate. The way you calculate the share of the investor in post acquisition profit, you should also calculate the share of the investor in the OCI. Okay, if the investment happens mid year, the calculation is naturally time apportion. Okay. Now, recognition of losses in an associate. If the associate entity suffers a loss, okay, if the associate entity suffers a loss, then naturally the way you calculate share of profit of the investor, similarly you will have to calculate the share of loss of the investor in post acquisition loss of the associate. Now, you will see ultimately the amount of loss will start reducing the amount of investment. You can keep on reducing it till it reaches zero, but not beyond that. If the associate subsequent, yeah, the rule is if an investor's share of losses of an associate equals or exceeds its interest in the associate, the investor discontinues recognizing the share of further losses. For this purpose, the interest in it is its carrying amount under the equity method plus any long-term interest which forms a part of the investor's net investment. After the investor's interest is reduced to zero, additional losses are provided for and a liability recognized only to the extent that the investor has incurred legal or constructive obligation or made payments on behalf of the associate. Now, have a look at this example to understand what I'm trying to demonstrate. So basically, whatever is the share of investor in the loss, start subtracting that from the total amount of investment. The moment it reaches zero, stop there. Don't go below that. And then the further treatment is also given to you. Just go through this once. Tell me when you want me to scroll. Done? Okay. Are you guys able to recollect this provision, by the way?
Yes, sir. Yes. Yes, sir.
Okay. Now, as see, the recognition of losses again is a critical point, and something like this might be tested in your section B question, or sometimes in section B they have like a 4 mark question on consolidation. In rare cases, we have seen that. Otherwise, section A is there. Now, as we discussed, there is no impairment of goodwill because there is no goodwill when you are accounting for an associate, but the investment in the associate entity could get impaired, and for that purpose, of course, you will have to subtract the amount of impairment from the total initial investment and then present the balance value in the remaining value in the financial statements. Indicators of impairment, I am sure you are aware of those. See, we are not talking about IAS 36 indicators of impairment. We are talking about the ones given in IFRS 9, which we have revised in the first session that we did. Now, looking at some intercompany transactions between the investor and the associate, let's have a look at how those transactions could appear. Now, at this stage, all I'm going to do is I'm going to discuss the steps with you. So, in case of an investor associate relationship, if there is an upstream transaction, goods sold by the associate to the investor, what you have to do is calculate the unsold stock, profit on unsold stock, share of investor in unrealized profit, reduce consolidated retained earnings, reduce inventory. The difference between this and subsidiary is that in subsidiary, you don't calculate the holding company share in unrealized profit. The entire profit is unrealized profit. Here you calculate the investor's share in the unrealized profit. Then, if you have a downstream transaction, that is goods sold by the investor to associate, then calculate the unsold stock, profit on unsold stock, calculate the share of investor in unrealized profit as per step 2, uh, into 30%, 40%, whatever that is, reduce it from the investment in associate and add it to the cost of sale. That is, you could also, or by extension, you could also reduce the amount of consolidated retained earnings. Just learn the steps when you go for the exam. Now is not the time to get into a detailed analysis of this. Now you just have to know what steps have to be done and go for the exam. Dividend from the associate entity, not added anywhere because share of profit from associate is already included. Now, along with associates, we also have a discussion of joint arrangements, and joint arrangements could take the form of joint operations or joint venture. See, joint arrangements are characterized by one critical aspect, which is joint control. And when do you say that two entities have when do you say that an entity has joint control? When the decision making has to be unanimous. And what do I mean by unanimous? All the parties who are, there, all of them have to vote and all of them have to say the same thing. If, say, for example, a decision requires unanimous consent from Satyamed, Vijay, and Garvit, then all three have to say yes, even if one person says no, and then the other two start arguing, ki, "Nahi, we have a majority, two-thirds majority is there, so you will have to listen to what we say." That is not acceptable. If it is a joint if it is a situation of joint arrangement, then joint control is there, which means unanimous decision making will be required. If you end up creating a separate entity, it takes the form of a joint venture. If you end up not creating a separate entity but just operating together, then it leads to joint operations. Now, in joint operations, the accounting treatment is that acquisition cost is expensed off and identifiable assets and liabilities are measured at fair value. And what each co-venturer or what each joint operator could do in this case is each joint operator will calculate assets, his share in assets, his share in liability, his share in expense, his share in revenue, and all those individual items will be added in his financial statements under the respective heads. Okay. Now have a look at this simple example to understand how does the joint operation function. It does not have to be consolidated like a subsidiary. Please keep that in mind. Okay. So this is a joint operation. You don't have to consolidate that like a subsidiary, but the decisions have to be taken with approval from both the parties, and our individual share of revenue, expense, income, assets, liabilities will be added to our standalone financial statements. Apart from joint arrangements, you could also have a joint venture. Apart from like a so this is in this situation you end up setting up you have a separate entity that is set up, and it is the percentage shareholding will not matter. What matters is whether you have joint control over the entity. Now joint ventures are also accounted for in the same way as our associate entities are accounted for. Okay, so if and what is that method? That is the equity method of accounting. So in the equity method of accounting, you take the cost of investment in the joint venture or the initial amount. To that, you add the share of post acquisition profit. You subtract the impairment of the investment. If there are any intercompany transactions, you have to eliminate the profit aspect, and then you will get your closing value of the joint venture investment. Now, there are a couple of adjustments in joint ventures, which, by the way, in most of the study texts, these are not available. And so in the study text, they have not even mentioned these adjustments, but they are in the study hub. And there were a couple of past papers, rather two past papers, where these were asked. What adjustments are these? This is a situation where the there is a joint venture and one of the co-venturers has sold something to the joint venture. If one of the co-venturers has sold something to the joint venture, then how much profit should he account for is the question. In this case, he should account for the share of profit of other parties, excluding his own. So, if Plutus Education is a joint venture between me and Mayank, and I own 40% shares, Mayank owns 60% shares, and then I sell an asset to Plutus Education, and the profit is 10,000, then I will not account for the entire 10,000 as my profit. I will only account for the share of the other co-venturer, which is Mayank in this case. So I will take 60%. And there is one special case in this. What is that special case? If the holding or if the investor company, one of the investor companies or co-venturers, that co-venturer sells an asset to the joint venture. Okay, it is a downstream transaction between the investor and the associate, where a non-current asset is sold by the investor to the associate, and the sale value is less than the cost. Or sale value is less than the carrying amount. Carrying amount is 10,000, sale value is 8,000. This is an indicator of impairment of that non-current asset. And in this case, I will not account for the share of the other party only. I will account for the entire loss in my current financial statements altogether. I will repeat the situation. This is the downstream transaction. Investor is selling a non-current asset to the associate, and the carrying amount is 10,000. This is sold at 8,000. So that means there is an impairment because the fair value is less than the carrying amount. In such a situation, the entire amount of impairment loss will be recorded, not just the proportionate share of the other party. These two adjustments, one of these adjustments was in DigiWire, the other adjustment was in another exam kit question. I just can't recollect the name right now. But the fact remains that if this situation arises, then the accounting treatment should be what I told you just now. I will also show you the relevant part of the study hub where you will find this particular adjustment. Guys, do you remember having done these questions in the class? Mayank,
Yes.
Trisha, याद है ना towards the
Yes, sir.
Yes, sir.
this question, these two questions rather, very important and very different. You don't expect this adjustment because in any of the study materials that you see now, this specific concept is not there. I'll just show you the adjustment in the study hub. Okay, just give me one moment. Joint operations, yes. So it's like a blink and a miss thing, but they have asked it in the paper. So 17.4.2, sale or contribution of assets to a JV. purchase of assets from a joint operation. Rather, this paragraph, it contains quite a lot of, it's very important. We usually tend to ignore that. And the second point, which I told you, investor sells a non-current asset to an associate. It is sold at an amount which is lower than the carrying amount. Then the entire amount of impairment loss should be considered. Now, in the group, I have shared a link to my Drive folder. If you want, you can go through the questions there, but this happens to be an important adjustment, something that you cannot afford to miss when you are preparing for your consolidation chapter. Now, in consolidation, you will often have a situation where there is acquisition in steps or disposal also happens in steps. Okay, but before that, one critical adjustment. Whenever the holding company acquires a subsidiary company, then all the assets and liabilities of the subsidiary company should be included in the financial statements of the should be included in the consolidated financial statements at their fair value. Now, there are 4 points of interest here. What are these 4 points? If there is a contingent liability in the in the financial statements of the subsidiary, there is a disclosure relating to contingent liabilities, then that contingent liability is recognized at fair value in the consolidated financials. Provisions for future operating losses are not included. Now, intangible assets of the subsidiary which are not recognized in the subsidiary's own books will be included at their fair value in the consolidated financial statements, and any goodwill that was already present in the books of accounts of the subsidiary, that was goodwill acquired by the subsidiary company, when the consolidation happens, this acquired goodwill of the subsidiary is not considered. It is ignored in the calculation. And when you sit down to calculate purchase consideration, you will, of course, include deferred consideration uh, at its present value, and contingent consideration is included even if the payment is not deemed probable. You will include that at fair value. Acquisition costs are excluded from the calculation of purchase consideration. Legal and professional fees and issue costs are not considered. And if there is a replacement share-based payment scheme, then say for example, the entity that you have acquired, it had a share-based payment scheme of 3 million, and you went out and you replaced it with another scheme so as to compensate the shareholders, but this scheme was worth 4 million. So out of the 4 million share based payment scheme that you set up, the 3 million will be included in the purchase consideration. The remaining amount will be included as post acquisition remuneration expense. Okay, now before going ahead, let's take a quick break. I'll be back in like 6-7 minutes and we'll continue part of the. So we could have situations where earlier you held around 30% investment in an entity, and then you went ahead and acquired another 40%, which makes your stake 70%. And in that process, you go from the status of an associate to a subsidiary. So this is a situation of step acquisition. What you are going to do is remeasure the previously held equity interest to fair value, recognize the resulting gain or loss in profit and loss account or in other comprehensive income if that is the classification you have chosen, and then calculate goodwill and NCI on either a partial or full basis. How to calculate goodwill? Fair value of interest previously held, which you have remeasured. To that, you add fair value of consideration paid for additional shares. You add fair value of NCI at acquisition date. You subtract fair value of net assets of subsidiary at the acquisition date, and you get the goodwill on acquisition. In case of disposal of a subsidiary, there are two situations. Either you could have a full disposal or you could have a partial disposal. In the standalone financial statements of the investor, that is the holding company, the profit or loss on disposal will be calculated as sale proceeds minus carrying amount of shares sold, like your regular any other situation. In consolidated financial statements, see, because the subsidiary is sold during the year, you have nothing at the end of the year to left to consolidate. So balance sheet mein you will not have any other adjustment. In consolidated P&L, till the date of disposal, calculate whatever is the proportionate share of revenue, sorry, whatever is the proportionate revenue and expense and all of that. Do a line by line consolidation only till the date of disposal. And Ultimately, you will have to calculate the profit or loss on disposal in consolidated financial statements. Ab, how is that calculated? Disposal proceeds, add fair value of interest retained. Fair value of interest retained is, say, for example, you had a 70% stake in the subsidiary and you sold 50% of it. So 20% is still there. That is a partial disposal situation. Then you will add the fair value of interest retained and you will subtract one total. What is that total? Net assets of subsidiary at disposal date plus goodwill at disposal date minus NCI at disposal date. This net figure, you will subtract it from the total value that you have calculated here. You will get profit or loss to the group as a whole. Just remember that this figure and the figure in the standalone financial statements is not going to be the same. These figures will be different, but make sure that you learn the steps and follow the formula when you are calculating this in the exam. Now, this is not something which should basically waste a lot of your time. If something like this comes, quickly finish it off and move on to the next one. Now, apart from this, we have a situation of a control to control scenario. What is a control to control scenario? Where earlier you held 70% and now you have sold 10% of the holding and you hold 60%. So while a disposal happens, the status of the entity doesn't change. It is still very much a subsidiary. You are very much the holding company. It's just that the proportion of non-controlling interest undergoes a change. So if you are doing this control to control transfer, then no goodwill is calculated. So goodwill is not recalculated, rather no profit or loss arises on such a disposal. What you have to do in a control to control scenario is compare the cash proceeds received and calculate the change in the value of NCI or change in the overall NCI value. Compare that with the cash proceeds received. Whatever difference is there, it gets routed through other components of equity. The same thing happens when you are increasing your stake in the subsidiary, say from 80%, you are increasing that to 85%. When this kind of an increase is happening again, it's not as if the status of the company is changing. It was a subsidiary earlier, it is a subsidiary now. What you have to do is you have to compare the amount of cash paid with the amount of decrease in non-controlling interest, and the difference gets routed through other components of equity. If a subsidiary has been acquired exclusively with an intention to resell, a subsidiary acquired exclusively with a view to resale is not exempt from consolidation. However, if it meets the held for sale criteria in IFRS 5, it is presented in the financial statements as a disposal group classified as held for sale, and it is, of course, shown in a different way, but still consolidation happens. Instead of doing a line by line consolidation, you take the total of all assets, write it there, take the total of all the liabilities, write it separately. Held for sale criteria has to be fulfilled, but consolidation will still happen. Your argument cannot be, or the CFO's argument cannot be that just because we have acquired this subsidiary with an intention to resell, we can choose to not consolidate that. That relaxation is not available. And presentation of disposed subsidiary in the consolidated financial statements. एक बार go through this. Yes. But you know what? They will usually be available, or they will give you a way to calculate those figures. It's not as if, otherwise, that calculation won't really make sense. They will have to give you those values. Okay. And guys, when it comes to disposal of the associate in a consolidated financial statement, disposal proceeds plus add fair value of interest retained, less carrying amount of associate at disposal, you will get profit or loss for the entire group. Cool. So that's how you would deal with disposal of an associate. Guys, you have to understand that the level of detailing that is possible in a regular class 4 days before the paper, it is a little impossible, bordering on impossible for me or anyone to do that, because that takes time. Now, when we do a regular class on consolidation, we spend around 20 hours with consolidation, right? Right from knowledge level concepts and building it up to P level. Abhi, that is not possible. You have to focus only on the steps. Even you should not go in that level of detail. Steps dekho, move ahead. Steps dekho, move ahead. Which is why for a foreign subsidiary, there's only steps that will help you tackle a foreign subsidiary situation. But let me outline how to tackle a foreign subsidiary balance sheet and P&L. And then we'll also understand how to tackle a consolidated cash flow. In case of a consolidated balance sheet where you are consolidating a foreign subsidiary. Okay, so non-current asset, current asset, non-current liability, current liability of the subsidiary company should be converted into the currency of the holding company using the closing rate, that is the balance sheet rate. Okay. Then non-current asset, non-current liability, current liability has to be consolidated line by line like you always do. Now, calculate the net assets on the date of acquisition of the subsidiary company and on the closing date in foreign currency, and calculate the post-acquisition profit, which has to be split between holding company and NCI using the average rate. Now, calculate the goodwill. Sorry, goodwill calculation comes a little later. Do this critical working. Opening net assets converted at the opening rate. Add profit converted using the average rate. Closing net assets converted using the closing rate. So, you perform this calculation. A plus B will give you a certain number. Compare that with C, because C is translated using the closing rate. It will not be the same value. And in this situation, whatever is the difference, that is called as foreign currency translation gain. In step 4, it is an OCI item. Then calculate goodwill of the subsidiary company in foreign currency. Then perform the same working. Opening goodwill less impairment, closing goodwill. Opening goodwill convert using opening rate. Impairment loss convert using average rate. You get a certain number for that A plus B, or A minus B rather. Compare that with the closing value of goodwill, convert the foreign currency goodwill into a domestic currency using the closing rate. The difference between these two is again a translation game, which is an OCI item. Prepare consolidated retained earnings by adding share of holding in post-acquisition profit of subsidiary. Calculate NCI. And most importantly, uh, the value that you calculated in step 4, when you calculated the translation gain on the net assets and the translation gain on goodwill, take the total of those two, multiply that with the share of holding company, that becomes your foreign currency translation reserve, and add or less share of NCI in step 4 and step 6, whatever you calculated here, translation gain or loss, step 6 translation gain or loss, calculate the share of the NCI in that and add it in the NCI working. Okay, now there are very slim chances of the entire consolidated balance sheet of foreign subsidiary coming, but if it does, follow the 9 steps and you will get your answer. Same thing applies for consolidated P&L. Convert all incomes and expenses of the subsidiary into the currency of the holding company using the average rate, then calculate the profit. Now, from balance sheet, step 4 and step 6, add the values to the profit in the OCI part. Then this profit and this translation gain or loss ka difference is your total comprehensive income. Calculate share of NCI and then get the share of holding company. Uh, I haven't seen too many questions being tested on foreign subsidiary, but off late they have started changing the way they ask questions. So I'm seeing a lot of consolidated cash flow. I will not be surprised if a question comes on foreign subsidiary. You have the steps with you. I would want you to go through those. The rules covered in the chapter don't apply only to subsidiaries, they also apply to associates and JVs. Remember that income, expense, and OCI are translated at the exchange rate in place at the date of each transaction, but basically you will use the average rate. Assets and liabilities are translated using the closing rate. Exchange gains or losses are recognized in other comprehensive income. And when a foreign operation is disposed of, the cumulative exchange difference recognized as other comprehensive income and accumulated in a separate component of equity become realized. So basically what they are saying is whatever gain or loss you had recorded as a part of, other comprehensive income, when the subsidiary entity is disposed of, that particular part gets transferred to P&L. Just give me 1 second, guys. So that was about a foreign subsidiary. I'm sure some of you will be surprised because we spent, I think, if I look at the data properly, we spent almost an entire class dealing just with a foreign subsidiary. So naturally, that will, of course, because there we had to explain the whole concept. Here we are just looking at the rules. Now, when it comes to a consolidated cash flow statement, there are some basic hygiene factors that you can keep in mind when you are approaching these questions. Let's start with the most basic. When it comes to acquisition of a subsidiary, and you are looking at the amount to be shown in the investing activity part, the amount that you show is acquisition of subsidiary, amount paid for acquisition, net of cash acquired. So if I acquire a subsidiary for by paying 5 lakhs, and when I acquire the subsidiary, I also acquire control over all its assets, including cash. Now let's assume that the cash balance was 25,000, then 5 lakh minus 25,000 net amount will be shown. Similarly, when a subsidiary is disposed of, I could be disposing of a subsidiary for 8 lakhs, and when I dispose of the subsidiary, receive 8 lakhs, I end up losing my control on the 70,000 cash, that cash balance that the subsidiary had. So naturally, I'm losing control on the 70,000 cash balance. So I will show disposal of subsidiary net of the cash disposed or net of the proceeds at 7 lakh 30,000. Now, when it comes to working capital, that adjustment will often be tested in the consolidated cash flow part. So, opening balance as per consolidated financials less, so closing minus opening as per consolidated financials, less value of subsidiary acquired, add the value of subsidiary disposed of, and that is the final value you should show in the outer column. So, keep this formula in mind. Then, cash paid to NCI, oftentimes what they will do is they will give you the balance of non-controlling interest, the total profit earned during the year. So for example, opening NCI is 100 or 1000. Okay, share of profit of NCI is 1400, which means the closing balance of NCI should have been 2400, but the closing balance is 2000. That means the dividend of 4000 has been paid to non-controlling interest, and dividend paid to non-controlling interest is considered because the dividend paid, sorry, non-controlling interest is basically outside the group. Okay, transactions with the associate are included in the consolidated cash flow. Ideally, what I would recommend is, see, there is a question called Pearl Company in the study text of Kaplan. I have solved that entire question. It's a 1 hour solution, by the way. It's a long solution. But if you have the time right now, I would recommend that you go through this solution once. I have shared the sheet with you in the revision group also. Make sure that you go through that. Make sure that you absorb that. Because once you know all the adjustments in that question, then I don't think there is anything else outside that, perimeter that they will ever ask you. Now, one situation in the paper could be, pay attention, it could be a situation of mid-year acquisition. Okay, you have already covered that at the skill level. Let me quickly recap that for you. First, I'll tell you what happens in the consolidated P&L. If there is a consolidated P&L, holding company acquires subsidiary company sometime midway during the year. So let us say that the financial year runs from 1st of Jan to 31st of December. Okay. and the holding company got a share in the subsidiary company on 1st of July. So you should only consolidate the profits post. So you should consolidate the incomes, expense, revenue, everything after the 1st of July. So 6 months part only you should consolidate. That is how you will deal with that in the consolidated P&L. The adjustment in the this thing consolidated balance sheet is slightly different. Now, how is it different? Please understand. In the consolidated balance sheet, see, you need net assets on the date of acquisition and you need net assets on the date of on the closing date, balance sheet date. Now, net assets on the balance sheet date are easy. Net assets on the acquisition date, usually what happens is the acquisition date is the start date of the year. But what if the acquisition date is somewhere in the middle of the year? So, see, share capital doesn't change, share premium doesn't change, revaluation surplus is not that difficult. The only thing that you have to be careful about is retained earnings. Now, pay attention. Retained earnings on 1st of Jan 1000, retained earnings on 31st of December 2000. I need retained earnings on 1st of July. What I will do is, see, retained earnings on 1st of July is 1st Jan retained earnings plus 6 months profit. Do you agree, Garvit?
Yes, sir.
So, okay. So my opening retained earnings is 1000. Profit earned for the 12 months period is 1000. So 6 months profit will be 1000 into 6 by 12. That is 500. So the retained earnings on acquisition date will be 1000 plus 500, and then all other calculations are exactly the same. There is no impact whatsoever, just the opening balance of retained earnings plus the profit earned for that particular period should be added in the should be added to arrive at the retained earnings on the date of acquisition. In your exam, what you will get is you will get a pre-populated balance sheet. What is a pre-populated balance sheet? There, certain values are given to you. Okay, I'll show you what that means. Something like this will be given to you, like this draft consolidated statement of cash flow. Okay, and naturally, there are some errors in this cash flow statement. You will have to analyze the data and make changes to it. Maybe this decrease in inventory figure is wrong, so you will have to give the correct figure. Okay, that's pretty much it. And not the entire 30 marks part is on pre-populated balance sheet, but the individual calculations definitely help you in the drafting of the pre-populated balance sheet. Now, whenever a question is on pre-populated cash flow, pre-populated balance sheet, pre-populated anything, just ensure that you stay vigilant in terms of the adjustments given. If there is a deferred tax adjustment, if there is a fair value change, if there is, any of these things, just be very, very careful of how information is flowing from one part to another. It's not that it is a tough calculation or a tough expectation, ऐसा नहीं है, but oftentimes na we get so carried away with, or we get so overwhelmed with the number of adjustments that have been thrown in our way that we lose track. My approach to this is, whenever I'm updating, I start from the top. I don't start anywhere in between. I start from the top. I read the first adjustment. Say, for example, it relates to revaluation of non-current asset, and deferred tax is also mentioned. If there is a revaluation of non-current asset, the entry is non-current asset to reval surplus. So when I do this, when I write this adjustment, I will update the value in the consolidated balance sheet non-current assets. I will update the revaluation surplus. So two effects have been given. Then there is a deferred tax entry. Okay, so I know that when I do the deferred tax calculation, I have to show it in the consolidated balance sheet, and I also have to reduce it from the net asset working. So when I'm doing those individual adjustments, now I will give double effect for everything. If I don't pay that much attention, if I don't look at that double effect, then naturally there is a possibility that the balance sheet will not get tallied. Now, some tips for all of you when you are approaching the paper. Okay, first of all, walk into the paper with a certain amount of cockiness, I would say, ki bhai, I know everything. Because the moment you become submissive, na, the paper will start tormenting you, and I don't want that. Walk in as if you know everything. Step one. Step two, glance through the paper, but don't start reading the entire paper, because that is only going to add pressure to you. Why am I saying glance through the paper? Because all of us have certain strong areas. Like for me, I would say my strong suit is financial instruments, for example. And I see a question on financial instruments. I know that if I attempt that question first, I will be able to finish it in the least amount of time and it will act as a confidence booster. So do that question first. And then of course proceed. The ideal sequence, what I recommend is start with ethics, then go to section B, and then come to consolidation at the end. Why am I saying this? Because see, ethics question has more or less, it has, like a predictable outlook in the exam, that something has gone wrong and that there is professional competence issue and there is integrity issue and blah blah blah. So framing that answer is not tough. Plus it's a 20-mark question. You try to finish that in 35 minutes maybe, and then 35 minutes have gone, or maybe 40 minutes have gone, and then you look at the clock and you feel, okay, 40 minutes have gone, but one question is done. Now let me go to section B, finish off the section B questions quickly, and then come to section A. The first question of any paper is usually designed to slow you down. It's not a test of intelligence, it's a test of patience. But sometimes the calculations are too long. Sometimes, there is some adjustment which is meant to confuse you. So it will act as a speed breaker and you will get stuck in a loop when you are doing question one. So you will get stuck in that 1.5 hour is gone. You are left with only 1.5 hour, and then you start panicking. Oh my God, I have 3 questions left. I'm not going to make it through. To avoid this situation, start with ethics, then go to section B, then come to consolidation. If you are very, very confident with consolidation, then go ahead with that. Nobody is stopping you. You have to do what works best for you. What I say is secondary. Now, see, my approach depends on how I feel the ideal sequence should be and what I have seen other students succeed with in the past. You can have your own approach, no problem. Don't fall into the trap of over explaining anything. Whenever you are referencing a concept, say for example, in the ethics question, you know that integrity is in question, or you know that professional competence is not there. Specifically highlight the word professional competence, mention, and then explain. If you don't mention, you lose marks. In quite a few mocks that I evaluated this time, that was one major issue that I noticed, that you are talking about the problem, you are explaining the problem, but you are not mentioning the problem. So ACCA will not give you marks for that. Make sure that you do it. It's not necessary to write the answer in paragraph forms. You can write it in point form also. If you are short on time, do that, no problem. Now, the answer has to be divided into 3 parts. Which are these 3 parts? The first part is provisions of the standard, facts of the case and analysis, and then conclusion. This is the ideal approach. Do we need to remember the provisions word for word? No, you don't need to remember the provisions word for word, but certain words are non-negotiable. For example, equity instruments recorded through OCI. There we have a word called an irrevocable decision to designate it through OCI. See, that word cannot change. You cannot have a non-cancelable word cannot be used in the place of the word irrevocable. So be careful when you are framing that answer. Make sure that you don't too heavily emphasize on certain things, in the sense provision likho, mention the keywords, and then go to the analysis. Don't spend so much time in trying to get the perfect statement there that you are not able to complete the answer. Again, I will repeat, 4 questions done with 85% accuracy fetch more marks than 3 questions done with 100% accuracy. If you feel that a particular part of the question is taking too long, drop it, come back to it later. You will have all the time in the world, but you cannot afford to break your heads over a question about which you are not sure. If you don't know, then spending 5 more minutes is not going to change. Spend time on that when everything else is done. Then come back to such questions and distribute your time properly. And see, it's not going to be a tough paper, but it is a paper which tests patience. And think, don't say I only have 3 hours. Say I have 195 minutes. The way you say that line brings about a change here. And once the change happens here, it will automatically reflect in the paper. See, remember when you were in grade 10th also, it's not as if you knew every page and every line of every subject, right? You did not know certain things and yet you have done very well in life. So in the exam, while preparing, if you are not able to do a particular concept because of shortage of time, it's okay. You still have the rest of the paper to clear. And that will help as long as you have the right amount of confidence. You cannot be doubting yourself when you are going for the paper. I have marked out the important topics, given you a list of the hierarchy in which things have to be done. We have revised all the standards, something that I did not do with so much focus in the previous batches. We have revised also all the critical standards. You have all the notes contain, like, a very detailed analysis of everything. Maybe now focus only on those topics that you know, and now don't solve any new mocks, don't get into anything new. Whatever you have done so far, focus on that. That much knowledge is enough to clear the paper. Also remember, worst case scenario, you don't know something worth 10 marks, 15 marks, it's okay. You still know other stuff worth 85 marks, right? You can write that part and you can clear the paper. But if the expectation is that you should know everything, then guys, let's face it, when we were in grade 10th, back then also we didn't know everything. Okay, everything is a myth. Perfection is a myth. Do what you can do with the resources that are available with you, with the amount of time that you have. You are Tell yourself that you are well prepared. Tell yourself that, okay, I have done it enough. And if any curveball is thrown at me in the paper, I am mature enough. I am at P level. I am mature enough to tackle the curveball. Okay. Do not be hard on yourself. Certain topics like sustainability and all of that, make sure you do it properly. Make sure that you devote adequate time. Just one thing that I have to discuss with you. I mean, we have discussed it in class. Um, just 1 second. There is a discussion on going concern that I think has become important of late. So, where is it? Okay, ethics part. You can read I have shared the technical article for in the digital age, what changes are expected to take place. So I would want you to go through that properly. uh, एक बार go through going concern wala discussion, not much. And going concern, where is that? They have, okay, just this one particular tab na. Oh, by the way, I got this message from a lot of people saying, has IAS 8 changed? No, IAS 8 hasn't changed. What made you believe that IAS 8 has changed? It's just that this going concern part, do that carefully. Just read it once and you will be good to go. We have discussed this in class. Just make sure that you go through the going concern wala discussion. Ek bar it's 5.1.3. Go through it properly. Baki, if you observe everything, by that I mean everything has been done. Even the questions on analysis and interpretation, reportable segments we have done, management performance measures, MPMs and APMs. APMs are basically what we did in Benito Company, and all of these, those are additional performance measures. Benito Company, Guidance Company. So basically we are sorted on that front. Still, I would want, if you want to go through it all over again, I would say as a last minute thing, na, just note it down somewhere. Read 20.4. Just tell you here. I want you to read 20.4. Just read these. We have covered these already. Even MPMs were covered in IFRS 18. These were covered in different questions, but just go through this once. Sustainability, we have spent quite a lot of time on each of these issues, by the way, be it natural disaster, be it climate change, be it crypto. We did discuss how should it be classified as intangible asset, as a financial asset, that specific part. Then global event, climate change, we have covered. I have given you questions on all of these end to end solved. So that has also been discussed in the session. So everything is prepared and Everything that was necessary to clear the paper is done from not just my end, even from your end. Now, don't go hunting for something new. Don't visit multiple websites and don't talk to multiple people and do opinion shopping. Don't do that. Focus on what you know, focus on the notes, and you are well sorted for the exam. You don't have to do anything else. Okay? So I wish you all the best in your preparation and do well without adding any burden to yourself. And this time I will be doing the pre-exam ritual tomorrow because on Wednesday I might not be in a network area. So I will be doing the pre-exam ritual tomorrow instead of on Wednesday, which is usually one day before the paper. I'll switch off the recording. Passion I have seen off late in all students, this is something everyone does. They just love to get tensed because unless you get tensed, how can it be an exam? So you just keep on adding unnecessary burden to yourself, burden of whose expectations? Your own. It's, let me tell you, 1 year down the line, the marks that you score in the paper are not going to matter. By the way, even on the next day after the result, they will stop mattering. What is the most you can do about it? Write one beautiful LinkedIn post and get 200 likes on that. What matters is the process that you did and whether you enjoyed and whether you understood financial reporting in this process. If that has happened, then please remember that 51, 81, 101 is irrelevant. No one cares. You will also not care. Trust me. So focus on completing the paper and focus on applying the knowledge. Marks, the only people who gain through your grade score is people like me, the faculties. Because you have made all the effort, you end up getting a 91. I will put it on my LinkedIn that my student Mayank got 91 and Garvit got 89 and Trisha got 101. I will put it on my LinkedIn and people will think I have put in an effort. No, you have put in an effort. I'm just trying to take the credit for that. Everyone does that. But you understand you are not doing it for me now, you are doing it for yourself. So you shouldn't care about what others think. You should care about keeping your mind calm. See, increasing your blood pressure, adding to your stress, anxiety, and all the words that people these days use. I don't understand half of them. Why do you want to put yourself through that agony? Now, stay calm, yeah. It's an exam. And there will be many more exams, and there have been so many exams in the past. Not the first time you're writing a paper, and definitely not the last time you're writing a paper. There are other ACCA papers, you will do other courses, you will do many things. This cannot be the deciding factor. All you need is that 51. But yes, don't keep that low aim of 51. Keep a good aim of sailing through the paper, getting a good score, and that's all. Don't worry about other things. Okay? And more than anything else, now trust your effort, not my effort. See, I do this every quarter, and I will do this for many more quarters. But you have put in an incredible amount of effort, attended so many classes, you have done so many questions, you have written mocks, you have done everything. It's okay. You have put in the effort. Trust that. Everything else is in your control. All the best. And Abhi, I'll not talk about anything else. Just focus on staying calm. Okay? Bye. Yes, Mayur.
Sir, I attempted the second mock that you sent, so will you be able to evaluate it today?
Yeah. See, as long as you send things till tomorrow afternoon, 12, I can evaluate. Monday, I'm going out. And even after that, if you send anything, that feedback will not make a difference to you. है ना?
Okay, sir. Thank
Right. Now you can send till tomorrow.
I'll also send it today.
No problem. You can send it till tomorrow. I will evaluate. After Sunday, it doesn't make sense to evaluate.
Okay, sir.
Yeah. So, bye.
Thank you,
Thank
sir.
you so much.
Thank you, sir.
Bye, sir. Thank you.
Thank you, sir.